Hi friends, so welcome back to our financial planning series video. There has been a gap of some time in our video series, but I think we'll make it regular now onwards. So today I'm going to talk on an important topic called this biography of an SIP. I think we have done multiple videos where we have mentioned that SIP is one of the most useful tools for long-term wealth creation, and this video I am recording with the help of a content which has been prepared by White Oak Mutual Fund. So the entire content has been used of theirs, and why I have used their content is this document which they have prepared is very useful and does talk about how critical it is for an investor to continue their SIP. See, we are a registered mutual fund distributor, and if you see, when we look at our clients' data, also in the end, I'll also talk about how our client performance has been. But what is very critical is that you continue your investments for a long period of time, despite the noise which you may hear in between. You will see markets going down, continue with your SIP. You will see markets going up, continue with your SIP. So SIP should be continued. This is the critical message. The key message which we are going to pass on is SIP should be continued irrespective of what is happening in the marketplace. Don't look at your negative returns, or don't look at positive returns and get excited or sad. You will see this with some practical data, which is, I think, over the last 20 years data has been used here. So in order to explain about biography of an SIP, that is how an SIP investment goes through, we are going to look at an index called Nifty Midcap 150. We are starting with our SIP on 1st April 2005. That's the date I'm starting with my SIP, and I start with 10,000 per month, a very minimal investment. I start with that investment, and my plan is that this SIP should continue for a long period of time. But in the interim, you will see some of the challenges where an investor, because of the emotions playing out, or because of other conditions or other constraints, he may be forced to withdraw the money. So if you look at here, the initial time period when this investment happened, the returns were very healthy for the investor. So don't worry face. First year he generated an 85% XIRR. This 2 years together, this is 2006 and 2007 put together, then 2007 and 2008 put together, and suddenly in FY 2009 a subprime crisis had happened, an event which impacted all the financial markets. Another event which you may be able to relate it well, maybe the COVID phase when it came in, when you saw markets crashing down. So suddenly my investment from FY 2006 till 2009 is negative 21% XIRR. So from a positive XIRR, I have invested 4 lakh 80, but the value is only 3 lakh 35. The only thing which we want to suggest is, at this stage, you should not worry about this and continue with your SIP, because this is the stage where even some of our clients came back to us during the COVID phase and told that, should I discontinue my investments, let me take my money out. Whenever the markets are crashing down, you should continue with your SIP. Or whenever markets, for example, the first year 1 lakh 20 became 1 lakh 17, that does not mean you take the money out. You continue with your investment. If the person had continued, which 99% of our clients continued, when you continue with the investment, you look at the returns became positive 18%. The XIRR, this is from the beginning period, it became positive XIRR. So this FY 2010 was 1 year which gave very significant returns, which kind of took care of the FY 2009 problem. Same thing happened during the COVID scenario also. When COVID came in, the returns were very negative, and suddenly when the performance got improved, you could see that everybody making money and the returns going up significantly. We normally suggest that around 12% is a return you can easily expect in your mutual fund investments. Then this is the first 5-year phase where you could see a year where the investor would be worrying a lot, and then things became better for the investor. Now the next time, the next years is you see a stay patient phase, because your XIRR is going down year on year. It is going down because in this 3 years the benchmark was delivering negative returns. There were time period where the returns were very less. Still, what has happened is our investment did not get into negative trajectory. The reason for that is we have continued for a longer period of time, but our returns have become very minimal, 8.5%. But again, things will change. That is why you should continue with your investment. And you could see FY 2014 and 15 recovery happening, and XIRR again going back to more than 12%. It became 17% XIRR in FY 2015. So 6, 7, 8, you could see weakening of performance, but 9 and 10, it's very difficult for a person to time their investment. So you cannot exactly predict. FY 2015 was a fantastic year. Similarly, FY 2010 was a fantastic year. These 2 years kind of took care of the FY 2009 problem, and FY 11, 12, 13, the consolidation phase. Then comes the next phase where you could see returns being there, but then the challenge again came in during the COVID time. The challenge did come in during the COVID time where the returns again went below 12%. But after the COVID's uncertainty, you could see performance again going back to a very healthy level. And if this person had continued with his investment from FY 2005 till FY 2023, 21 lakh 60 of his investment would have become 1 CR. That is, he would have made a return of 15%. No other mode of investment can give you such healthy returns. You have fixed deposits, you have government savings. None of them can give you these kind of returns, and this is equity investing is the only way for an investor to generate returns which can beat inflation. Also, this is beneficial from a taxation angle as well. So why we are discussing this video is just to explain an important fact that whenever you see negative returns in your investment, don't get worried about it. You should continue with your investment for a longer period of time. If you keep doing that, returns will automatically come. You need not worry about returns when you continue to do your SIP. Don't try to do any kind of basically trying to reduce your SIP during some months, increasing your SIP, seeing how markets are going. Let's not worry about the noise in the market. Markets will keep going up and coming down. As of now, market is very healthy, but you may see market suddenly crashing down also. When markets crash, that's in fact a good time to invest. But you need not time your investment. You need not worry about what's happening in the market. You continue with your investment. What is your job is please continue with your investment. Everything else will be taken care of. This is a biography of SIP where you saw first 3-4 years. First year was a very fantastic return. Then 3 years, very healthy return. Fourth year, everything became negative. Then fifth year, suddenly huge positive returns. Then you saw some consolidation phase. Suddenly one more year of healthy performance. Again a consolidation phase. Suddenly returns going down because of an event like COVID. Again returns improving. You look at FY 21, from 8.7 it has gone up to 15.7. That is, a 36 lakh rupee has become 77 lakh rupee. Almost double the value. Wherein we invested only 1 lakh 20 extra. So staying invested is very, very critical, and you should continue your SIP for a long period of time. Even when you want to withdraw money, there's something called a systematic withdrawal plan. You should withdraw your money through SWP phase. Now, this data was also seen in our clients. We normally suggest to our clients that 12% is a return which you can expect from your mutual fund investment. Now, in the month of March in the current year, when Nifty was at 17,000, our clients who had invested for a longer period of time had 70% of our clients had negative returns. Some of the investments were only for 1 year period, some of them were for a 2 year period, some of them were for a 3-year period. Some of them started at their peak when post the COVID happened, but there were different category of clients. We have clients who are in triple digits. So people were having negative returns, but none of our clients said that we want to discontinue. And by the May month, you could see none of them having negative returns, and 88% of our clients had a return more than 12%. So these are real numbers, just to show you that staying invested is very, very critical. Don't try to take out the money. Taking out the money during weak phase of markets will not help you. If you continue staying invested, you will make healthy returns. And also don't expect returns like 80%, 90%. That could be for a very limited period of time. Maybe when I showed you that example, it was there for only 1 year period. But normally, as time passes by, returns will stabilize at around 12%. So the most important message for you is stay invested, and if you stay invested, you'll be able to create corpus over a long period of time. Thank you, friends.